Good afternoon, everybody. Thanks for joining us. I'm gonna just pop something. There's a pamphlet I just put in the chat box and download it or not. Just give you something to reference. I'm going to be kind of talking to some loan programs today. But first off, thanks everyone for joining us and happy holidays. I feel like once we get into Thanksgiving, we're in that time of year. So I'll say happy holidays. Then I'll say happy New Year for the next 3 months after this. So kind of the way I roll. But I'm going to do a share screen here. For those of you who've been here in the past and who haven't, this is meant to be kind of like an open discussion, which usually means I end up talking most of the time just because I don't let other people get a word in edgewise. But please just unmute yourself, chat away. Chris is on here as well, so between the two of us, hopefully get either of our attention or Chris, if you see something in the chat box there as well. But how I usually start off these calls is talking a little bit about interest rates. But before doing that, we did revamp our webpage. The one difference that you'll note is they blew up the picture like tenfold. So you got my big face there. And yes, it is an old picture, but of the new ones I've got, I just haven't been satisfied with. So, but as you go through here, it's a bit more interactive. Not to say we got complaints about the old ones, but the calculators, the articles, more buyers go right to here to start an online pre-approval application. So just know these are all just great resources. Feel free to link these. Feel free to, when it comes to articles and such, feel free to, pull from this. I mean, most of you who are doing your 33 touch probably have kind of already sort of stock, items to put out there. But if you want to take anything from here, just please do. It'd be great if you gave us credit, but I don't care. So just know that it's there. It's got some great information. And more and more buyers, as opposed to just saying, well, I learned this on Google. I've had a few people say, hey, actually, I saw that on your webpage, or I read about this. So it is getting some traction for what that's worth. So just wanted to share that first off. And then I knew how to get this bar out of the way all the time. To touch on interest rates a little bit. So if you've been on any of my calls or videos before, you've seen me reference this one, Mortgage News Daily. This is a more of a, it's somewhat commercial, but it's less a commercial sort of site where they're trying to pull in consumer data. This is more to put out mortgage information. So this is telling you, this is a good way to kind of get a better idea of where the true sort of average interest rate is nationally, which is hovering right at about that 6.75%. Look at the 15-year, and I'll mention the 20-year is there in between as well. We're doing a lot of shorter term loans, 15 and 20-year, provide the buyers both qualified and comfortable with that. But it's a conversation we have had with everybody, because somebody may call and say, yeah, I want a 30-year fix with no points. Great. That's probably what they may get, but we do want to let them know what all options are. Our big thing is to educate and let the customer decide, of course. So I just wanted to mention that. And then just to get a little bit more zoom in here of where rates have been. Let me just get rid of a few of these. So this is where you've seen the 30-year fixed, because we're going back over the last 12 months. I think we're on a year here. Yep. For the last 12 months is last year when let me just scale that back a little bit, 5 years. So it was just a year ago, well, a year and 2 months ago, rates hit over 8% for the first time in 25 years. So we're, nobody's doing cartwheels over a 6.77% interest rate, but hindsight from where we were, we should feel pretty good about that. Now, somebody who's got, that shorter distance rear view mirror, yeah, they're going to be a little bummed that they didn't jump on something here. And I added it up somewhere, well, just from what I noted, and probably more, between 50 and 60 people refinancing right here. And about 80% of those said, nah, I'm going to wait for something better. And that ship has sailed. I'm still talking to most of them. Some of them have kind of talked themselves into refinancing. I should say talked themselves into it, but it's made sense still. But hindsight being 2020, an opportunity was missed here. And are we getting back there real soon? So here is, this is as of within, the past 10 days or so. This is where these quote unquote experts or entities are predicting interest rates to be by the year end 2025. So you can see most of these are basically right about where we're at right now, 6.8, 6.75, 6.6. The more optimistic ones getting into the low sixes, and then there's still the NAR out there at 5.8%, and I wouldn't be surprised if they kind of back off on that a little bit. So the thinking here isn't, Redfin probably wouldn't tell you, yeah, rate's going to stay at 6.8% for the next 12 months. They're probably more thinking it's going to jump up before it comes back down. And some of these other ones may say that as well. So just to give you a bit of an idea, but any questions or thoughts or comments on rates? Yeah. All right. Cool. So what I'm going to, I think I make sure that went in the chat box here. Yeah, and if Chris, I guess if you just keep an eye, if anybody else jumps out in there on there, I don't think they'll be able to download that pamphlet. So just let me know, and I can drop it back in there, or you can as well. But so this pamphlet that I was going to go through, sorry about this. There we go. So the one I put in the chat box, it's actually in a Word document. For some reason, this pamphlet is 40 megabytes, and I know most people won't be able to download that, especially if they're looking on their phone. So I figured I would just put it on a Word doc, and it's the image is not quite as clear, but you'll still have something to reference there. So what I was going to do is I'm not going to, I could literally spend about 30 minutes on each one of these programs, but for your sanity and for the sake of time, I'm going to kind of give you a bullet point one. But the main thing I want you to do is just kind of think about, the lower right-hand corner, conventional FHA, VA, USDA jumbo, those make up a good chunk of the mortgage. And some of these kind of dovetail back into these. But just want you to be aware of what's out there. I mean, these are all programs that we offer. Obviously, we don't have a monopoly on these programs. Other lenders do. Not everybody offers all of these, but we like to think we're kind of a catch-all. And for programs that we don't have, commercial, for example, is a weak spot. Lot loans, we have avenues for those, but I'll typically refer those out. But yeah, we like to be all things to all people. And, all of these programs, I could say with confidence, we're very good at them. Very competitive, and we'll talk through some of those. Here, I'm 9 minutes in. I'm already losing my voice. Sorry. So, Chris, you might have to pinch it here at some point.
Sure.
So, full doc loan. This is his board, or excuse me. Actually, yeah, I'll come back to that one. So, non-QM, or what we call our CCM signature expanded. This is sort of, I kind of refer to as our outside the box. Sometimes it's the break this glass in case of emergency. But financing, you can see right under the title for full doc, financing beyond traditional guidelines for those in unique financial situations. So you have somebody who just, they got 20% down, they got good credit, but something's quirky. Maybe they haven't been self-employed for a full 2 years and the numbers aren't working, or maybe they have some sort of credit blemish. This is kind of one of those, we've got a home for it. You're going to pay a little bit higher cost or interest rate, but we've got a home for it. So that's kind of what the non-QM department is. The bank statement program. So, and a lot of these I'll give with, hypothetical examples, or in some cases, real life examples. But this is for somebody who's self-employed. So let's say somebody comes to me and they've been self-employed for 3 years. As often is the case, they've got a real creative accountant, or maybe just, the way that the numbers look, there's a lot of expenses to offset the income. So maybe their bank statements show that, yeah, they're consistently bringing in, $15,000 a month, which is $180,000 a year. But by the time their business is closed out at the end of the year and the accountant gets to all of the write-offs, maybe they only make $60,000 a year. Everybody on here knows someone who makes 180 versus 60,000 a year is going to get 2 different loan qualifications. So we will not look at the tax returns. We'll confirm with an accountant that the business is still operating and businesses, what we're looking at is still ongoing. But we will look at just their deposits and say, yeah, they average about $15,000 a year, $15,000 a month in revenue and ingoing bank deposits. We will count that as their income. Again, they're not going to get a 6 3/4 interest rate. It's not going to be 10 or 11%. I mean, unless there's some other sort of hair on the file. But just know that is a very more common option than what we've seen before. Investor cash flow, or as most of us know, DSCR, debt service coverage ratio. So this is for somebody only buying an investment property, 1 to 4 unit. So same thing here. We're not going to look at tax returns. We're not going to even ask, hey, Mr. Buyer or Mrs. Buyer, do you have a job? We're going to skip that part of the application because we're looking at is the cash flow of the property. So this is more thought of as like a business loan. Okay, I'm buying a 2-family home. Regardless of what my income situation is, I don't want to show it, or maybe I just don't have any income, whatever the case might be. But this 2-family home, the payment's going to be about $1,400 a month. When I rent both units out, it's $2,000 a month. So I'm cash flowing by $600. Common sense. Does a buyer pay their other bills? Yes. Do you think we're going to be able to pay this bill? Yes. With it fully rented out, are they covering it? Yes. Is there a little cushion? Is it's not a dollar for dollar wash? They're actually profiting here. Why not? So it is a great loan. You can do this on purchases. You can do it on refinance. You can do it on cash out refinance. It is a great, great program that is that's out there. The rate, to give you an idea, I just closed one of these not too long ago. It was either just over or just under 8%. Now, before you think, oh, geez, that's a high interest rate, it's an investment property. Someone buying an investment property with a traditional Fannie Mae loan might be paying 7.3, 7.6% right now. So it's not that big of an adjustment. And this for, kind of the savvy investor who, when I say savvy, they might have some creative, accounting practices, and, they may own 6 or 7 or 8, 10 properties, investment properties, and living off the cash that's there. But because it can be kind of buried within the taxes, that income might not be taxable. So any comments or questions on the DSCR loan?
I got an interesting one for you. Yeah, sometimes when I can't sleep, I just read these guidelines for fun. And I came across an interesting thing with the DSCR program. We can actually do mixed use where they don't own the business that's going to be using the storefront. So think basically storefront on the first floor, apartment on the second floor. It's basically half a store and half of a living space. With traditional financing, you can get a conventional loan with that, but they need to own the business. There's a bunch of extra stipulations. I would worry about it. That's one I'd want to get fast track approved with an underwriter. The investor cash flow DSCR program, they don't have to actually own the business. So it's interesting because that teeters almost on like a commercial loan, like a business banking loan. So if you come across something like that, my thinking is like, you're ever driving down like Coventry or Little Italy, and there's all those storefronts with apartments above them, that would be the perfect program for it.
Well said. Yeah, this department's always just sort of like, hey, we say no to stuff, but run it by us first. That's kind of their motto.
Yeah.
Asset qualifier. So here's a quick one. Had a couple. Woman just went through a divorce. Currently wasn't working. Has no alimony, child support, or anything like that, but had a lump sum, chunk of funds in her name. Her boyfriend, they were buying a house together, had just retired, no pension, no Social Security or anything yet. So we had a couple, no income, zero, not a penny other than interest and investment income. And we did an asset qualifier. Basically, they're buying a house for $400,000, putting 20% down. They needed a 320 loan. And you might think, oh yeah, you got good credit, you pay your bills, but there's no income. How could we do this? Well, they had $600,000 in kind of just their own kind of liquid cash assets, meaning retirement as well. So we said, you know what? If you wanted to, you could pay this thing off. We'll give you a 320 loan, slightly higher interest rate, a little bit extra costs. They close and they're literally living happily ever after as we speak. Their income's probably going to reset over the next 12 months. They might come back and refinance, but they're perfectly fine. And this was a Saturday night, 9 p.m. pre-approval. And I was sweating it, and we got it. They were under contract the next day. So 1099. Anybody on this call know what a 1099 is? Yeah. Yeah. All right. If you're a realtor, you're receiving a 1099. Well, we will, let's say I'm a realtor and I had $100,000 in sales last year. You can bet you know what, that I'm going to find every penny in marketing and dues and mileage and everything to write that off. And if I got a real good accountant and I'm good at keeping my paperwork, I might only have $30,000 in income. That's going to reduce how much I'm qualified for. Well, the 1099 says, don't show us your tax returns, just show us your 1099 for the last 2 years. I won't label this one the realtor special, but most of the 1099 loans, probably myself and Chris have done, have been for realtors with good 1099s and really good accountants. Um, Profit and loss is similar to the 1099. I mean, it's technically kind of like a mid-year kind of tax returns. We don't see that one much, but that's there. And then written verification of employment. So this, again, usually we're going to try and go everything Fannie Mae or Freddie Mac, but when something just doesn't quite fit the bill, we'll kind of crowbar it in here if we can find a way. So that's kind of our non-QM. Like I said, we could spend time on much more of those, or non-QM just in general. But any thoughts or questions on that? No? So non-traditional products, bridge loans, we do bridge loans. We do bridge loans. A lot of lenders don't do bridge loans. We do out-of-state bridge loans. So if somebody's moving from Tennessee to Ohio and they want to put a bridge loan on their Tennessee house to buy a house here in Ohio, we can do that. Most lenders will not, for whatever reason. We do. So just, again, I do a whole class on bridge loans, but this is tapping into the equity of the home the buyer currently owns. So just to give you a quick rundown, if I own a $200,000 house and I have a $100,000 mortgage, the bridge loan will give me an extra 60. We do 80% of that 200, pay off the first mortgage, $60,000 left over. That's used to buy the new home or pay down debt, do whatever the guidelines allow. And it's a 4-month loan, so the house does have to be listed by the time we close on the new home. But it's a great program. We're doing the recast scenario, which I've talked about that ad nauseum in the past, instead of bridge loans, probably more commonly, just because they're more cost effective. But we do bridge loans, so just to make sure everybody's aware of that. ADU, the ADU, this would be, I've got a single family home and then I got a garage in the back that's kind of a carriage house, second unit on top. It's not technically a 2-family home, but it's kind of this added rental space. Or sometimes you have like a 2-family home with that awkward 3rd floor attic, has a bathroom but not a kitchen. These are ADUs. So we do work with these. I mean, Northeastern Ohio, we don't bump into these very much at all. California, out west and other states, Florida probably to some extent, see these pop up a lot more. But we do use the rental income on those. That's been a problem with the past, and with a lot of programs don't limit that. We do allow that. Loan level pricing waivers. So I won't get too much into what LLPAs are, other than the fact that these are someone applies for a mortgage, or let's say Chris and I are both buying a house, and Chris has got 5% down, pristine credit, and it's a single family home. Let's say I'm putting 5% down, but my credit stinks. It's a 660 credit score and it's a condo. Well, because it's a condo, there's points charge, or the rate goes up. Because my credit score stinks, it's going up more. Those are loan level pricing adjustments, basically the characteristics within the file, within the customer or the property, that adjust it. Well, we have waivers. If a buyer is a first-time buyer under roughly $96,000 in income per year, that there's a waiver where we do not have to charge those. So there's countless examples where I'm talking to somebody. I had an interesting scenario. I had a married couple. Of course, the wife had perfect credit and the husband not so much. And his credit score really stunk up the file. So we took off the wife, right, who has the better credit score, just so we could remove her debts and her income from the loan. Now we've got the husband whose income brought us under $96,000. We're giving him a better interest rate than both of them are on there. It's sort of a paradox, kind of whatever goes again logical thinking. There's a better word for it. But anyway, we could be very strategic. Whether the buyer pays a 6% interest rate or an 8% interest rate, I get paid the same. So I would love for everybody to get about a 2.5% interest rate. So we'll work as hard as we can to get the best rate, home buyer money for grants, whatever we can to kind of get there. But so those are the when we've heard of loan level pricing adjustment waivers. Renovation, Sandy Lutz. If you are going to be doing a renovation with me, you're going to hear a name, Sandy Lutz. And she sounds like a, Kaiser Soze, like a made up name. She's an angel behind the scenes, and she is our renovation specialist. She's crazy because all she does is renovation loans, and she absolutely loves it. These loans definitely have a lot more work for both the loan officer, for the buyer, for the realtor, for the contractor, but we do these. FHA, not all lenders are doing those. VA renovation, almost nobody does those. We do those. USDA, and we even have a renovation HELOC. That's somewhat of a limited program, but we absolutely do renovation loans. We do I'd say once a year, maybe more. We've done some renovation Zoom talks or meetings upstairs. So we may revisit that as well, but wanted to make you aware of that. With renovation, just kind of a heads up, you do need a longer close. 3 and 4 week closings are frankly not going to be possible. Usually I suggest 45, 60 minimum, and sometimes 60 to 90, because the experience that the speed and pace is going to depend not entirely, but greatly on the contractor, because, some contractors are great with their craft, but not great on paperwork and quotes and estimates and contracts. And there's a lot of that once they get bought into the loan process. So be aware of that. New construction. I don't know if anybody on there has done new construction with us. We do a lot of new construction nationally. Northeastern Ohio, certainly doesn't have quite the construction as out west or down south as much, but we still do have a pretty good market share for this. But we will do FHA in addition to conventional VA, second home investment even. The second home investment is tricky because you do have, with the renovation as well, you do have to keep the property for at least 12 months. Some investors like, hey, I'm going to buy it, build a house, and then flip it. We can't do those type of loans, but nonetheless, there is a product that does exist to build those if they're going to keep them. So, any comments or questions on construction? Nope. Your standard vanilla, I won't spend too much time on these, but conventional Fannie Mae, Freddie Mac, just to run through some of the highlights. For a primary residence, 5% down is the minimum. If you recall, just about a year ago, they changed the rule. Fannie Mae specifically will allow you to do 5% down on a 2, 3, or 4 family. So prior to last December, you had to come up with 15, 20, or 25% down, even when it's a primary residence. That's not the case. So Elliot, you can move out of your current home, rent that out, and go buy a 4-unit, 5% down. So now you got plans for the weekend. Freddie Mac, who's kind of like almost the equivalent of Fannie Mae, does not allow that. So kind of as I always tell, Fannie Mae and Freddie Mac, if you take their 1,100-page manuals and stack them next to each other, about 1,000 pages are the same, but about 100 pages are different, pertaining to student loans, goofy things like that, and some other gift stuff. And conventional for first-time home buyers, you can get away with just 3% down. And then don't forget, we got a 2% grant for some, so that amounts to 1% out of pocket. We have a $6,500 community promise grant. I have a customer today who is signing their papers around between 4 and 5 o'clock today. After the loan closes, she's getting a check for $6,500 because she put a $6,500 earnest money check down. Between the grant we gave her and the seller credit she ended up getting, she paid 0 out of pocket. We paid for her appraisal. She's getting earnest money back. We're paying for a home warranty for her free. And the only thing I believe she paid for is a home inspection. So not a bad deal. Yeah, so really cool story there. FHA, 3.5% down. There's some grant options there. OFA being the most popular. VA, of course, 0 down. USDA, 0 down. Jumbo, so I think it was, you've seen it in other places, but we posted it as well. Fannie Mae and Freddie Mac, the new limit loan limit for conforming loan amounts, that is to when a property becomes jumbo, is 8065. So if somebody's borrowing 8065 or more, then they fall into the jumbo classification. Sometimes it's higher rates. Down payment is 10% down. We do have some no PMI options there. There's additional requirements like even for petty little things like homeowners insurance, there's an additional requirement tacked onto the insurance declaration page, extra hoops to jump through. So if you got, if you're in the jumbo world and have questions on that, just, feel free to let us know. And we're pretty creative. Like if you got somebody who's got a $900,000 loan and they still want to go, with a lower amount down, we've got some other options to try and make that work. You can do things with second mortgages and such as well to, avoid PMI and get better interest rates and such. So we're very strategic with that. So not to get, I don't use the word cocky or arrogant, but we, Chris, myself, Don, a couple other guys, I mean, we've got years in this business. We don't like to, Don likes to use the term headset jockey. There's a lot of lenders out there who just market, pick up the phone, and they just take the buyer and just cram them into whatever program they're selling. It's a 30-year fix. They're just going to follow all the scripts and guidelines. Myself, Chris, Don, we like to take more of that consultant approach, saying, let's get to know each other. Let's get to know your finances. Yeah, you may end up with a boring old 30-year fix in the end, but let's just walk through all the options. Maybe look under the rock. Maybe see there isn't an opportunity for savings. Don always gives it a great example. He had another customer. When someone gives a positive a rating or good or bad, whatever it is, it comes through. But Don had a nice one, and it was from a customer that he kind of met with where, classic example, I want to put 20% down. By the time he sat down and went through their finances, they put 15% down. They qualified for our no PMI, 15% no PMI program, same interest rate. And with that extra 5%, I don't know what the dollar amount was, they wiped out all of their credit card debt. So it's sort of like, hey, I don't know the exact loan amounts or whatever it was, but getting rid of all of so not only did Don help them get into the house, he essentially was a financial planner. And if anybody knows what credit card balances, or excuse me, credit card interest rates are these days, it's huge. So anyway, just want to take a little side note there. So any comments or questions so far?
Hey, Sean, it's Maria.
Hey, Maria.
I was just curious if you could, I have actually a couple questions, but let's start with going back a few items ago. Can we talk about bridge loans and recasting of loans and how those can go together? When you've got someone who has a house, but they need to sell that house in order to buy a new house.
So let's go to that scenario I mentioned. So I own a house for 200, I owe 100 on it. If I'm doing a bridge loan, that means my new bridge loan is going to be $160,000. So on the house that I already own, I'm going to take $160,000 mortgage on that, pay off the existing, and I'll have $60,000. That's going to be my down payment on the next one. That bridge loan does have closing costs. You're going to pay a few $1,000s in closing costs there. So let's say I'm buying a $300,000 house on the next one. I've got 60 to work with. Perfect. I've got my 20% down. It kind of dovetails into there real nice. So I've got a 240 mortgage on the new one. So I've got 160 old, 240 new, two mortgages, two sets of closing costs, and that may work perfectly fine. And that's kind of the old-fashioned traditional way of doing it. Now, what I could just as easily do is, instead of doing the bridge loan, let me just leave that mortgage where it is. Let me just leave that $100,000 loan on the house that I have and keep making the $1,000 payment or whatever I have on there. So I'm not going to touch that. On the new house for 300, I'm going to put together 5%. I'm going to come up with $15,000. Maybe it's my checking and savings. Maybe it's borrowing from my 401k. Maybe it's a gift from mom and dad. But I'm going to come up with $15,000 and have a 285 loan on my new house.
Okay.
Still got two loans, but I'm only have one new one set of closing costs. And on that new loan, I am going to have PMI because I only put 5% down. So there I go. So now I got both homes. Maria sells that house in the first weekend, multiple offer, 32 offers. I take the highest and best. It's a cash offer and it closes 2 weeks later. So now I sold that house, and let's just say I've got $80,000 cash from the sale of my old house. What am I going to do with that money? Well, maybe I take 15,000 of that and pay back my 401k loan or wherever I pulled that from. I still got 75 or what I said, how much did I say money I had? 80 minus 15, so I have $65,000 left over. What I can do is I'm going to call customer service, or I might call Sean and go, what was that recast thing? How the hell does that work? I'm going to call customer service and say, hey, I'm going to put $65,000 down on, towards my mortgage, and I want to do a recast, not a refinance, a recast. Customer service rep is going to say, no problem. Wire that money in here. We're going to take an extra $250. That's it. And then we're going to send you loan modification paperwork. It's not a new application. It's not a new appraisal. It's not a new credit report. I get that. They're going to take my 285 balance or whatever the balance is at that point, take 65 off of there. So I'm going to have a 220 loan, and they're going to re-amortize that payment for the remaining 29 and a half years or whatever it is. So that's what a recast is. And if you do the math there, I've got 20% equity. I don't need PMI anymore. So we'll cancel PMI all at the same time. I like the recasting better because you don't have two loans, you don't have two appraisals, you don't have two sets of closing costs. Yes, you're going to have a higher payment initially, but hopefully, Maria's on the job. I know the house is going to be sold quick. So it'll be a short kind of period. So don't forget, you always skip a month before that first payment too. So hopefully there will be a very short window or none at all where there's going to be kind of two payments in a given month.
And there's no penalty or anything if it's done like automatically, like within, a few months? Do they have to pay on that one loan for like 6 months or a year before they can do the recasting?
Different lenders are going to give you different answers. We used to say 6 months, but frankly, we've done it in 2 months. My sister did it, after she made her first payment when she bought her house. So we typically tell people, you're supposed to wait 6 months, but we routinely do it before.
Okay.
Chris, anything I'm missing there? Feel free to jump in.
I don't think so.
All right. So the other part, the page 2 of this, and keep in mind, page 1 and page 2 parts of this little trifold are nothing. So in case you're staring at the clock, some specialty government programs that are out there. So this kind of might fall under the did you know? If you have someone buying a home as a primary resident and it's a residence and it's a HUD home. So for those of you who aren't aware, a HUD home is a bank-owned property, or essentially not bank-owned. Someone bought a house with FHA. They didn't make their payments. House was foreclosed on. HUD now owns it. HUD's the seller. And you all know there's a different process to bid and purchase a HUD home. But first-time buyer may need only $100 to buy that house. We could even bundle that with a 203K renovation for $100. Now, there's not a ton of homes. I think in all of Ohio, there's less than 100 HUD homes right now, but that does exist. That's there. There are opportunities. And as foreclosures go up, you'll see a bit more of those, but be aware of that. The good neighbor next door. So this isn't kind of the OFA Heroes program, but it's kind of has the same sort of thought. But if you've got a teacher, a police officer buying a home, that's a HUD home. Let's say it's people are bidding $70, $80, $120,000 on it. Their offer might get accepted at 50% of what it's listed for. So it's got to be primary residence. I think they got to stay in the property for 12 months, but what's it like getting a house for half price? And that's even when other people are bidding higher of that, double whatever the end price is. So be aware of this. Ultimately, if it's something you're thinking, oh, this could be good for someone, or maybe that's a niche you want to go after, let's get one-on-one, and I can show you the program guidelines in a bit more detail, but it's a pretty cool opportunity. Section 184, we don't bump into that too much in this area, but it's specifically for Native American type of stuff. Other unique features, you haven't heard us talk about this much, but temporary buy down. So when rates were set over 8% last October, I had a guy who he bought a home. The seller was giving him 3% back, right? This was a it was let's call it a 400 sale price. So he's getting $12,000 from the seller towards closing costs. That was too much money. And this guy was freaking out because his payment, with the rates being over 8%, he'd been looking for most of the summer. So this payment was getting out of hand. What he ended up doing was doing a 2-1 buy down. So the seller, the interest rate, like I said, it wasn't quite 8%. I think we were at 7.6% at the time. But we took not all, but most of that money and bought down his interest rate to 5.6% for the first year, 6.7% or 6.6%, whatever, in the second year, and then it's going to go back. He and I just spoke literally yesterday because he's thinking, should I refinance? And we're exploring that. But this dropped his payment significantly, and he was able to keep his head above water. And he had 2 properties at once. So there was a lot of stress going on back then. I mean, I vividly remember kind of how this all came together, and it was such a success story. And here we are just a year and 2 months later, and he's happy with it. We're just already talking about refinance plans and things like that. So temporary buy down is an option. Permanent buy down is more, when we just hear of commonly paying points, that's what the permanent buy down is. The temporary is usually a 1, 2, or 3 year thing. Down payment assistance programs. I mentioned a few, and I won't go into those. I usually in these fireside chats, we're getting into those a little bit. Community Promise is the big one, $6,500. No income limit. It's based on where the customer currently lives. So if someone's buying a house, lives currently in a designated area in, Cleveland Heights, and they're buying a house in Columbus, Youngstown, or Miami, Florida, we're going to give them $6,500. The Smart Start, which is a 2% grant, caps out at 4%. There's also a way to extend that to $5,250. There's the OFA program through the state. Still a great option, just with a really, really big hook, and that is if the seller moves out, sells, or wants to refinance within 7 years, they may have to pay back the entire amount of that grant. That's the downside, but we make sure every buyer knows going into it. Buy now, sell later. So we still have, for anybody who closes with us before the end of this year, so the next 3 weeks, should they come back and refinance in 2025, we're waiving their closing costs. Now, there's still title fees and might have to do an appraisal, but we waive all the lender fees. Sorry, waiving fees gets me all choked up and feel so warm and fuzzy about it. Delayed financing. If you have a buyer in a position, we're not seeing this quite as much. 2020 and 2021, when you were seeing 15 and 20 offers on a house, and a buyer was in a position to say, well, I've lost out on the last 3. The only way I'm going to get one is if I pay cash. A lot of times they're pulling cash from checking, savings, retirement, credit cards, mom, dad, brother, sister, whomever. They can pay cash for the house, and then after they after they close on the house, turn around and pull cash out. It's called the delayed financing exception. So it's a pretty common, I should say common, but it's any lender knows this, can do this. You'd be surprised how many loan officers don't know the rules and how this works. But it's a great strategy for somebody who has that. But the important thing is we have to document where the money came from. And if somebody gets a gift, that's a problem. If they get a loan from mom and dad, that's okay. So just if you've got somebody falling into that, they definitely want to talk with their friendly neighborhood CrossCountry Mortgage Hadley branch loan officer before the money all changes hands, so that we set up an exit strategy. Because if something is done wrong, there may be a requirement to wait 6 months, which, some of that might not be a problem. But if they borrowed that money at a 12% interest rate, that may be a problem. Or if mom and dad said, no, you have to pay this money back in 30 days, that'll be a problem. So anyway, just wanted to mention that as well. So that pretty much hits everything on my little list here. But any questions on any of those up to this point? No. Maria, any other questions? I know you said you might have had a couple extra. Okay, you're on mute.
Yeah, I think it muted.
I'm always interested in the Community Promise one and the Smart Start programs, thinking that they're out there and people don't know about them, and they, could definitely help people. I know there are different criteria and different locations of people, or whether they live or where they're going to buy. And I don't know that, I know the one is $6,500. The other one, I don't remember if it's $4,500 that it helps people with. But the Smart Start one, that's based on where you're buying the house, right?
No, so Smart Start, and Chris, if you don't mind, can you drop those flyers in the chat box?
Yeah.
Okay, thank you. So the Smart Start, let me pull this up real quick. Actually, you know what? Let me do this one. So Smart Start is not based on where you're buying. It's conventional. If you make less than, well, I guess it does technically, it depends on where you're buying and what your income is, but anywhere in Ohio or frankly, the United States, you'll be eligible if you're under the income threshold. So for Cleveland, or excuse me, Cuyahoga County, Lake, Geauga, Summit, if you're under $76,000 in income, we'll give you a grant of 2% up to $4,000. So it doesn't matter where you buy, your income will dictate if you qualify for that, and it does have to be a conventional loan.
Do you have to be a first-time home buyer, or can it be anyone?
You do have to be somebody has to be a first-time home buyer. So
Okay.
if I'm buying a house and I've never owned, but my wife has, I still may be eligible as long as my wife doesn't own a house now. This flyer, I specifically tagged it. If you notice, you got Wendy in the corner here. We could put together flyers with your information on there. So it's part of our co-marketing with Total Expert. We'll save that for another one, but just know that that one exists. So this is a very popular one. This one I like better, but it's kind of like, oh no, I'm sorry, it's the same one. CCM Promise. So this one is $6,500 based on where you currently live. Again, specifically conventional. It's specifically Fannie Mae. Condos are fine, 3% down, but it can be more. So this buyer I mentioned who's getting, buying a house for zero out of pocket, the $6,500 covered her 3% down. So we're sitting pretty. I have another one though. I had a guy, he lived in a apartment over on Van Aken, and his address qualified. He was putting 20% down. I mean, he didn't need the $6,500 to buy, but guess what? We'd be giving it to him anyway. He used those points to buy down his interest rates he used that money towards points to buy down his interest rate to 5.875%.
Wow, that's good.
So like, here's money. And he said, well, here, give me a lower interest rate. And that's what happened. So really, really cool stuff. And we'll also pay for the appraisal. What I was trying to find here, forgive me, I'm lost on my desktop. Let me just do it this way.
John, doesn't the Smart Start, if you're under the lowest possible income threshold, even give a little bit extra?
Yeah, if you're under, I think it's like 51, you can get $5,250.
Okay. Not that we find a ton of people in that bracket, but good to know.
Yeah, you'd be surprised actually. I mean, not you, Chris, but some of the agents out there, you might be surprised how many, for whatever reason. This is the map. So if you're thinking, God, that thing's hard to read, that's intentional. They don't want us to say like, all right, well, you on this side of the street qualify for this program and you on this side don't. So that's unfortunately, I'm not able to share this, but this gives you a little bit of a preview of what we got there. So, I mean, if you could see part of Richmond Heights, weirdly parts of Cleveland, like our corporate office is down on like, is it East 33rd or something?
22nd.
Area. If you go like 4 blocks east, it's in the area. Really strange. Parts of Maple Heights, Garfield Heights, parts of Shaker, I mean, Fairfax, parts of Bedford. So really weird. I mean, look at this. You got like a donut right around here for part of South Euclid, part of University Heights. I don't remember what this is, but not that area. So really weird little pockets there. But and how we do this is when we started the application, we take the buyer's information. I had one where we had a couple. She's like, well, I live with mom, but you can just put my address as my boyfriend or whatever the deal was. I said, no, where do you really live? And she said, well, technically with my mom, mom's address was in Euclid, which qualified. Wherever her boyfriend lived was not, and we were able to make it work. So believe me, we'll go. We'll press as hard as we can to try and come up with free money for somebody as long as they fall within the guidelines.
All right, good.
There's a very similar program too. And these names get confusing. There's the CCM Community Promise. There's also the Community Lending Program. What that one is first-time home buyers get a bit better interest rate. Not always. We have to kind of check the numbers because they change along with the market. But it seems to follow that same census map that you just saw, where it's based off of income and demographics. Basically, if someone's purchasing in that area, they may be able to qualify for a better interest rate. So if you've got a listing that falls in one of those areas, it might be worth, asking Sean to get some flyers for that program, just because someone, if they want to put an offer on your listing, they might just be able to get a bit better interest rate, no catch in that situation.
Right.
Yeah, I actually just had one. When we started the loan, there was something was wrong in the address. The zip code was wrong on the contract, and I just copied it from there. Once we fixed the zip code, it came in and it was like, oh, they qualify for this program. This program is underwritten externally, so it 3-week, 4-week close might be a little tight for that one when normally that's a slam dunk for us. But was able to call this buyer and go, hey, you're gonna have to take a first-time homebuyer class, but trade-off is we're gonna lower interest rate 0.25%. So it worked out nice. Yeah. Cool. Any other questions?
Sean, I have a question. Sorry, I'm driving right now too, so can't be on video. But can you define the first-time home buyer criteria and whether that time frame ever resets for people?
It does. So 3 years. So if you have not owned a home the last 36 months, you're a first-time home buyer. So if someone owned a home and sold it in 2021, we're going to look up on the county records, which, keep in mind, the county records weren't all that accurate with filings back in 2020 and 2021. But so if somebody, sold their last house in December 15th of 2024, they're not a first-time home buyer today, but they will be next week, silly as that sounds. So that will absolutely qualify them into a program.
Okay, perfect.
Good.
And some of these programs, just if there's 2 borrowers, one person has to be a first-time home buyer. A few of them, nobody can, but for all the ones we're talking about, just somebody has to be. But there's additional requirements like the 2% grant, the Smart Start. That's only if you're putting 5% or less down. So we're not going to give you 2% when you're already putting down 10 or 20. But the community promise is kind of no strings attached on that. And that 6,500, again, I mean, if it's $100,000 house, and I know that there's not many of those out there, that's over 5% down. That's huge. Or heck, go with 3% down. You got another $3,500 to go towards the closing costs. I mean, it's free money. Any other questions? No. Hey, Chris, anything you wanted to add?
I don't think so. I mean, these programs are pretty sweet. I mean, there was that article that came out the other day. What we originally wanted to give, what was it, 5 million or something, or
10 million, yeah.
10 million, and we've crushed it. Now we're like at 15 million, and they're not stopping these programs after we hit the goal. So, I'm just jogging my brain from all the deals we've done this year. How many had either OFA assistance or one of these community promise or community lending programs? It's just, I mean, it really helping out first-time homebuyers at a time where the market's frankly pretty tight. So
Yeah, I will say, I mean, I've been doing this for 25 years. Aside from, whatever that was, 2010, 2011, when they were just giving you $15,000 on your taxes for buying a house for a first-time buyer. Aside from that, this has the most options out there because the least amount strings attached. There's sort of like, it used to be like, oh, there's a great program coming. It's like, great, you got to make under $30,000 a year. And you're just sort of like, they're creating a program for someone who's not going to be able to qualify for a house. It's sort of backwards thinking. I was trying to pull up the article here, and it was mentioned Tuesday as well. The average age for a first-time homebuyer right now is 38 years old. So that's a combination of, that get-in price is so much more difficult. Prices are higher, affordability is crazy. I almost hesitate to bring this one up because I don't want to close things out on a sour note, but get this statistic, or this fact. According to Fannie Mae, who's in the home selling or financing business, returning to the affordability of 2016 to 2019 would require a 38% drop in median home prices, or a 60% increase in household income, or rates to fall to 2.35%. Well, the good news is I don't think home prices are going to drop 38% anytime soon. Bad news is I don't think median income is going up 60%, and we all know interest rates aren't going to 2.35. And if they do, God help us all in our economy.
Yeah.
We won't. I don't even think we'll be doing much refinancing, because if that happens, that means nobody has a job.
Wow.
Yeah. So that statistic is a little sobering, but I guess just the, how long after COVID do we ask ourselves, when are things going to get back to normal? Or is this the new normal? And I guess, it's probably, we're swinging back to whatever the new normal is going to be. But more to my point, there's more opportunities for assistance out there than I can remember there being, aside from that short window. And there's OFA, which is, I don't say always been there, but there's always been some sort of version of that. So there's opportunities. Some buyers are getting a little greedy. I mean, when someone's, a lot of these grants are conventional. So you've got to, fit the conventional bill for many of these. So that's unfortunately where there's not as much to offer FHA. And don't forget too, there's some city funded programs too. Euclid has one. I think it's $10,000 as long as it doesn't exceed 17% of the sale price. So there are some community-based programs, and part of me thinks that some of those might be coming back as well. But obviously with both administrations leading up to the election, we're making all sorts of promises. Well, we all know what happens with those promises, but there's some things that may come to fruition. So we'll see what happens.
That was going to be my next question. With the new year, can we anticipate, is there anything you can forecast in the new year that might be some home buyer assistance programs that might develop or be created?
I think something will come out. I don't know, kind of some of the things that came out in the past were always like, really, what's the point? Like in 2020 and 2021, they're like, hey, we're gonna start giving more money out for just, for first-time buyers or for home buyers in general. It's like, don't do that. There's already a buying frenzy. Just if you give everyone $10,000, you're just marking up the price $10,000. So I'm hoping it's towards, while I like not having income limits and all that, but, giving someone $6,500 to buy an interest rate is great, but giving somebody $6,500 who wouldn't be buying a house otherwise does make me feel, the money's going to a more worthwhile place, because it's making or break, that second option rather than the first. So I do think there will be something coming. But keep in mind, the government, the head of the FHFA, not HUD, not FHA, but well, take that back. There'll be a new director for FHA probably, because the current one will be fired on January 20th. FHFA, they'll be transitioning someone in there new, but that's one of confirmations, and that's lower on the list of priorities. All the headliners and the other the names getting thrown out there will be first. So it'll be, I think, later on in the year. You're seeing a whole bunch of things like the government's going to start attacking, closing costs. It's like, I have news for you. I've been a CrossCountry mortgage for 8 years. We raised our closing cost $100 in the past 8 years. Surveyors, not to say they, their fees have gone up 50%. Admin fees at real estate companies have gone anywhere from $0 to $200 to you know, $299 and 1195 I've seen before. Title company fees, escrow. I mean, again, I'm not just fees have gone up everywhere. We've raised our fees once, and that was a extremely modest amount. And to be honest, anybody who bickers, I'll waive that $100. This is being recorded now that I think about it. But anyway, talk to me about that later. But so costs going up, credit report. The credit report fee used to be about 28 to 45 to $50. It's now $250, and the credit scoring models have announced they're going to be raising it again. So guess what? Credit report fees are going to be going up. So the credit report fees have gone up about 400%. Okay,
That's terrible.
Yeah. I don't know, and there's a whole conversation separately about our is there a monopoly on credit scores and all that stuff. But anyway, that's a whole separate conversation. But it is getting a bit more expensive. You know, the lenders are not gouging or taking advantage of. You know, certainly one would say the mortgage companies, mortgage lenders, and big ones, small ones. There's so much more work being done behind the scenes. The amount of hands that touch a file now versus 20 years ago is crazy. And I used to say the stat was, hey, Mr. or Mrs. Buyer, I know there's a lot of closing costs here, but the average transaction, there's 45 people's hands who touch this file. Between the surveyor, the title company, the admin there, the realtor on both sides, their admin, the office staff, that number is probably up over 60, maybe 70. And keep in mind, we're leaning on AI and all these automated processes, which do speed up, but they more kind of monitor risk and kind of not cut corners, but save time there, not necessarily the hands and bodies on the loan. But anyway, I'm rambling on. I'll throw my soapbox away. But yeah, the short answer to your question, yeah, Maria, I do think things will be coming soon. No idea what it's going to be. You're going to see different things floated out there. You're going to see the political back and forth about that. And, you know, anything that I don't have a lot of faith in, you know, federal government, no matter who's in charge. So I'm not expecting or relying on a lifeline like that, but I do think something probably would be coming just to say, hey, we did what we said we were going to do. Cool. Well, we're right at an hour. I always say an hour trying to think, and I'm going to target 45 minutes and run a little long, but if you guys need anything, don't hesitate to reach out. Chris, myself, Don. Don's on an airplane headed back from a quick
1
little
minute.
weekend. But if you guys need anything, just you know where to find us.
Thank you.
Thanks
Thank
very
you.
much.